You found it, the perfect little place to turn into an Airbnb. You ran the numbers and it would cash flow beautifully. But then you walk into the bank and they hit you with the same wall everyone hits. Based on your tax returns, you don't make enough to qualify. And just like that, the deal is dead. Here's the part nobody tells you. There's a whole type of loan that doesn't care what your tax returns say because it qualifies on the income the property makes, not the income you make. So today I'm going to show you exactly how to finance an Airbnb with no income check. The real numbers a lender actually looks at and the one trap that can sink the whole thing if you skip it. Let's get into it. Quick note. This is education, not financial advice for your situation, and the numbers I use are examples to make the math clear. So use this to understand how it works, then talk to a licensed professional, that's what I'm here for, about your actual deal. So let's start with why this is even a problem. A short-term rental, an Airbnb, a beach condo, a cabin in the mountains can throw off a lot more cash than a normal long-term rental. That's the dream, a property that doesn't just cover itself, it pays you. But when you go to finance it the normal way, with a conventional loan, the bank doesn't really look at the property's income. They look at you. They pull your tax returns, they add up your monthly debts, and they run something called your debt-to-income ratio. And here's where it falls apart for so many people. If you're self-employed, your tax returns are written to show as little income as possible because that's how you keep your taxes low. Smart in April, brutal when you need a loan. If you already own a home, that mortgage is sitting on your debt list, eating up your ratio. And if you already own a rental or two, lenders often won't count all of that rental income the way you'd hope. So you can be doing great in real life and still get a flat no because a piece of paper says your income is too low. That's the wall. The normal loan kills a great Airbnb deal because of your paperwork, not the property's potential. So here's the move the bank won't volunteer. It's called a DSCR loan. DSCR stands for Debt Service Coverage Ratio, which is just a fancy way of asking one simple question. Does the property make enough money to cover its own loan payment? That's it. A DSCR lender doesn't ask for your tax returns. They don't calculate your debt to income. They don't care if you're self-employed or how many write-offs you have. They look at one thing, the income the property brings in against the payment on the property. If the income covers the payment, the loan works, and your personal income barely enters the conversation. Now, to be fair, if your tax returns do show plenty of income, a conventional loan can absolutely work, and it's worth a look. But for everyone who keeps slamming into that income wall, the DSCR loan is the door that actually opens. Real quick, if that just flipped a light on for you, do me a favor and tap like. It genuinely helps a small channel like this get in front of more people who keep getting told no. Okay, back to it. Now here's the part that's specific to an Airbnb, and it really matters. For a normal rental, the income is easy. There's a lease and there's a rent number. But an Airbnb doesn't have one fixed monthly rent. So how does the lender know what it makes? Two ways. If you're buying a place that's already running as a short-term rental, the lender can use its real history, usually the last 12 months of what it actually booked. If it's a fresh property with no track record, the appraiser pulls short-term rental data for that area, comparable Airbnbs nearby, and estimates what it should bring in. Either way, the lender lands on a monthly income number for the property, and one honest heads up. Because Airbnb income rises and falls with the seasons, a careful lender will often be conservative with that number, and some will even check it against what the place would rent for as a normal long-term rental, just to be safe. So when you run your own numbers, don't use your best month. Use a realistic average. And that brings me to the one trap that can sink this entire thing, and it has nothing to do with the loan. It's whether you're even allowed to run a short-term rental there in the first place. More and more cities, counties, and homeowners associations are cracking down on Airbnbs. Some ban them outright. Some make you get a special license, or they limit how many nights a year you can rent. And here's why that's so dangerous for your loan. Your whole approval is built on that high short-term rental income. So if you buy the place and then the city or the HOA shuts down short-term rentals, you're stuck. Now you can only rent it long-term for a lot less, and that lower rent might not cover your payment at all. The deal that looked amazing turns into a property that bleeds money every month. So before you fall in love with any Airbnb, you check the local short-term rental rules and the HOA rules first, not after. This one step protects everything else. Okay, let me show you the whole thing with real numbers. You find a property you want to run as a short-term rental, and the price is $400,000. On a DSCR loan, you'll usually put down 20 to 25%. Let's say 25%, which is $100,000 down, leaving a $300,000 loan. At an example rate of 7.5%, your all-in monthly payment, that's principal, interest, taxes, and insurance, comes to right around $2,800 a month. Now the income. You and the appraiser expect this place to bring in about $4,200 a month as a short-term rental once you average out the busy and slow seasons. So now we run the one test that matters. You take the income, $4,200, and you divide it by the payment, $2,800. That gives you a DSCR of about 1.5. Anything at 1.0 or higher means the property covers its own payment, and 1.5 is strong. The income beats the payment with room to spare. The loan sails through, and notice nobody ever asked for your tax returns. Now watch how the trap would wreck that exact same deal. Say you skipped the homework, you bought it, and then the city banned short-term rentals. As a normal long-term rental, that property only rents for, say, $2,500 a month. $2,500 divided by your $2,800 payment is about 0.89. That's below 1.0, which means the rent no longer covers the loan, and now you're feeding that property out of your own pocket every single month. Same house, same loan. The only thing that changed was whether you were allowed to rent it the way you planned. That right there is why you check the rules before you buy. And let me kill one myth because it stops people from even looking. A lot of folks assume a no-income check loan like this must come with some crazy high interest rate. It doesn't. DSCR rates are competitive, usually right in the neighborhood of a normal investment property loan. You might see a small adjustment for a short-term rental specifically, but we're talking a small difference, not some punishing penalty. You are not paying double just to skip the tax returns. So let's put the whole thing together. You found an Airbnb that cash flows. The normal loan said no because your tax returns don't show enough income. So instead, you use a DSCR loan, which qualifies on the property's income, not yours. The lender figures out what the place brings in as a short-term rental, confirms that income covers the payment, and approves you. No tax returns, no debt to income. You put your 20 to 25% down, you confirmed up front that short-term rentals are actually allowed there, and now you own a property that pays for itself, and then some. That is how you finance an Airbnb when the normal path is closed. This is education, not personalized advice, so talk to a licensed professional. That's what I'm here for, about your deal, your numbers, and the short-term rental rules where you're buying. And if this finally made the financing part make sense, do me a real favor and hit like and subscribe. This channel is still small, and every like and subscribe tells YouTube to put this in front of more people trying to build something real with real estate. It's free. It takes 1 second, and it's the single biggest thing that keeps these videos coming. I'll see you in the next one.